If you've been scratching your head trying to make sense of this wild stock market rally, you're not alone. According to Tom Lee, co-founder of Fundstrat Global Advisors, this is the most hated rally in history. Yeah, you heard that right. And here's the kicker. He believes stocks are still cheap. In today's video, we're diving deep into this powerful quote from Tom Lee's appearance on CNBC's Squawk on the Street. He breaks down why this rally has felt so uncomfortable for so many investors, and why there's still real opportunity ahead, especially if bond yields start to ease. First, I'll play you the clip of Tom Lee's interview so you can hear it for yourself. Unfiltered. Then, I'll give you my full reaction and breakdown of what he said, what it means and why it matters right now. After that, I'll walk you through one high-potential growth stock I believe is worth buying right now, based on the themes Tom highlights, and a few more insights of my own. So, if you only watch one video today, make it this one. Trust me, it's going to be worth your time. Before we jump in, do me a quick favor, smash that like button. Let's hit 1,000 likes on this one. Drop your thoughts in the comments. I'd love to hear what you think about this market, and of course, subscribe so you never miss the next big investing insight. Alright, let's get into it. Here's what Tom Lee had to say.
Our next guest calls the markets push higher from the lows, quote, the most hated rally. Tom Lee joins us, Fundstrat Global Advisors, Head of Research and CIO, joins us here at Post 9. Tom, it's great to have you back.
Yeah, great to see you all.
Why do you think it's been so hated? Because April was so sort of near death?
Yeah, I think it's hated because not only was it near death, but it was a dire economic scenario that in people's minds is still unresolved. And yet the markets have rebounded the entire decline and actually now approaching all-time highs. So it's been too fast, and I think a lot of people liquidated and then never got back in.
Which part was too fast? The rally or the April lows?
Both. It was a waterfall decline.
Yeah.
And we look back since 1900, of the 12 waterfall declines previously, almost all are V-shaped bounces, except for 2022. So I think it aligns with history. But even on my way here, someone stopped me and said that they're, just a person who watches CNBC says they're still bearish. They don't understand why markets have rebounded. I think the majority of people are bearish.
People stop you on the street to tell you that they're still bearish?
And then what do you say when they say they're still bearish? Do you
say buy, right?
What do you tell this person?
Well,
you probably love that.
This person watches CNBC because he was telling me that he's like...
Many people watch CNBC,
a lot
Tom.
of people.
Many, yes.
Yes.
We get stopped all the time.
Yes.
But what did you say in response to I'm still bearish?
Well, they said PEs are too high, and I said, but the 10-year can come down because Powell thinks there's inflation risk premium in the 10-year yield. And if that comes down, then PEs aren't expensive.
So I do wonder with that as your bull view, that rates can come down. So I mentioned the weaker jobless claims today and how that's sort of creeping up. I've sort of been sprinkling in some weakness in the jobs market. Do you think that the stock market will be able to withstand that if we really start to see weakness in jobs because it means Powell's going to be closer to cutting?
Yeah, it's a good question. Joe Weisenthal called it like a slow leak in the economy, and I think it's accurate because there has been this shock. We know that like in the Beige Book, port volumes took a hit, trucking took a hit, but is that just a blip or is that the start of a downturn? And I think the markets are going to be able to suss it out eventually. But, I mean, so many stocks are acting well and the guidance has been better that I think it feels more like a blip.
You now have the Granny Shots ETF, GRNY.
Yes.
This was a sort of a framework that you devised a couple of years ago, right?
Yeah, 7 years running. It was originally a core research portfolio called Granny Shots, and now it's the ETF.
So what's the construction of it these days?
It's 34 names, still concentrated, and it's focused on the themes like AI, cybersecurity, automation, monetary policy easing. We're glad it survived the Black Swan event this year because
it filled that gap. Yep.
Yes, yeah, and outperforming this year by 500 basis points, so it's a good year for Granny Shots. But I think it's a reminder that we try to get investors focused on long-term themes. Like AI doesn't really care about tariffs long-term, and cybersecurity doesn't care about tariffs. And so these are the names that, as you get through that, as that noise lifts, the stock should recover.
Have you been unnerved by any of the macro data that suggests maybe data center construction, manufacturing that second derivative is slowing a bit?
Well, the second derivative should eventually slow. But the need for AI and the innovation that's coming really is driving a lot of innovation. And when there's innovation, that's where economic value add comes in. So I think so much of global GDP the next 10 years is coming from AI and cybersecurity.
This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. So, first things first. Tom Lee comes out swinging by describing the current stock market rally as the most hated rally. Now let that sink in for a second. We're talking about a market that's pushing back toward record highs, and yet a huge number of investors are either skeptical, underinvested, or outright bearish. That's a paradox, and Tom lays it out pretty clearly. He explains that the hatred for this rally stems from how sudden and sharp the recovery has been. Think back to April. We had what he calls a near-death experience in the markets. There was real fear. The economic outlook looked grim. People were selling off, cashing out, running for cover. And then, boom, the market reverses, hard and fast. We're talking a waterfall decline followed by a V-shaped rebound. That's the first big point to take away. People didn't trust the rally because it came too fast and too hard. Many investors sold during the drop and didn't re-enter. So now they're watching from the sidelines as prices march back up, and they're bitter. And that bitterness, that's what makes this rally hated. But Tom says this kind of behavior is not unprecedented. He's studied over a century of data, back to 1900, and points out that most waterfall declines in the market are followed by V-shaped recoveries, except for 2022. So from a historical standpoint, this bounce actually fits the pattern. The speed might be shocking, but it's not abnormal if you're looking at long-term trends. Now here's where it gets interesting. Tom mentions that people literally stop him on the street and tell him they're still bearish, like random strangers are walking up to him and saying, "I don't believe in this rally." That says something about the sentiment out there. So what does Tom say to those people? He brings up the classic bearish argument. PE ratios are too high, stocks are too expensive, right? But then he hits them with a key counterpoint, and this is crucial. If interest rates come down, which Jerome Powell himself has hinted might happen due to inflation risk premia, then those high PE ratios start to look a lot more reasonable. In simple terms, if yields on the 10-year Treasury drop, stocks won't look as overpriced as people think. Lower yields mean higher stock valuations are justified. So if Powell eases up and rate cuts become more likely, then yes, even high-flying stocks could still have more room to run. Then the conversation pivots to the job market. The interviewer asks, what happens if we start seeing weakness in employment data? Will the market freak out? Tom brings in a great metaphor here. He references 𝗗𝗟 𝗧𝗢𝗨's idea of the economy as having a slow leak, not a blowout, not a crash, just a steady, subtle deflation. He gives examples. Port volumes and trucking have both taken hits recently, which were noted in the Beige Book. But Tom's view? These might just be blips. Temporary pullbacks, not signs of a full-blown downturn. And the way he puts it is smart. The stock market will suss it out. That's the beauty of markets. They digest uncertainty over time. And right now, so many stocks are performing well and delivering decent guidance that it feels more like turbulence than a tailspin. Then we get to one of the cooler parts of the interview. Tom talks about his 𝗗𝗟𝗧𝗧 ETF. If you're not familiar, this started out as a research portfolio focused on long-term themes and has now evolved into a fully-fledged ETF that's outperforming the market by 500 basis points this year. So what's in the 𝗗𝗟𝗧𝗧 ETF? It's 34 stocks tightly focused on key forward-looking themes: AI, cybersecurity, automation, and monetary easing. Basically, this ETF is a bet on where the world is going, not where it is. What I love about this segment is how Tom explains that long-term megatrends like AI and cybersecurity don't care about short-term noise. They're not derailed by tariff news or temporary slowdowns. These are foundational shifts in how the economy operates, and stocks tied to those shifts tend to outperform over time as the dust settles. And the name 𝗗𝗟𝗧𝗧, kinda quirky, right? But think about it. It's from basketball. A granny shot is unorthodox, but it works. And that's kind of the message here. Stay focused on what works, even if it feels awkward or contrarian in the short term. As for concerns about slowing data center construction or cooling in AI-related infrastructure, Tom acknowledges the slowdown in second derivative growth. Basically, the rate of growth might slow, but he's not sweating it. His point is this: innovation always creates new demand. The AI revolution is still just beginning, and innovation is where economic value really gets added. So while some macro data may look iffy, the broader innovation cycle still has legs. And in Tom's view, that's what really matters for long-term investors. So, To wrap it all up, here's my personal take. Tom Lee is painting a picture of a market that is misunderstood. People are still bearish, still afraid, still anchored to the fear they felt in April. But that fear is blinding them to the structural positives underneath the surface. Yes, the rally has been fast. Yes, some economic data is mixed. But history tells us that these V-shaped rebounds are actually normal. And more importantly, themes like AI and cybersecurity are driving long-term value that the short-term noise can't erase. Tom's message is clear. Don't get caught up in the fear. Focus on the fundamentals, follow the innovation, and understand that market recoveries often look irrational when they're happening, but make perfect sense in hindsight. If you found this analysis helpful, be sure to like, subscribe, and drop a comment below. Do you agree with Tom Lee's bullish stance? Are you still on the sidelines? Now let's dive into this super growth stock you need to buy now and skyrocket your portfolio. Today we're diving into the world of e-commerce innovation, and at the center of this revolution is Shopify, publicly traded under the ticker symbol SHOP on the Nasdaq. Over the past decade, Shopify has transformed from a small Canadian startup into a global powerhouse, empowering millions of businesses to thrive online. Whether you're a seasoned investor or just starting to explore the stock market, understanding Shopify's story is essential for anyone interested in the future of digital commerce. At its core, Shopify's mission is simple, yet ambitious, to make commerce better for everyone. This vision drives every decision the company makes, from product development to customer support, and it's what sets Shopify apart in a crowded marketplace. Shopify provides a comprehensive, user-friendly platform that enables businesses of all sizes to build beautiful online stores, accept secure payments, and manage their marketing efforts, all seamlessly integrated under one digital roof. With powerful tools and intuitive design, Shopify removes the technical barriers that once kept entrepreneurs from launching their own online businesses. Unlike selling on massive third-party marketplaces, Shopify gives merchants full control over their brand identity, customer data, and the entire shopping experience. This means business owners can build lasting relationships with their customers and truly stand out in a competitive landscape. Thanks to its intuitive interface and robust suite of features, Shopify appeals to a wide range of users, from first-time entrepreneurs launching their dream ventures to established global brands seeking scalable solutions. Its flexibility and scalability make it the platform of choice for businesses at every stage of growth. Over the years, Shopify has evolved from a champion of small and medium-sized businesses to an enterprise-grade solution trusted by some of the world's largest companies. This remarkable journey highlights Shopify's adaptability, relentless innovation, and long-term vision for the future of commerce. If you're enjoying this analysis and want to stay ahead of the curve with more deep dives into top investment opportunities, don't forget to like, share, and subscribe. Your support helps us bring you the latest insights on the companies shaping tomorrow's economy. Up next, we'll take a closer look at Shopify's impressive growth story, its financial performance, and the key factors that make it such a compelling investment in today's fast-changing market. The journey into Shopify's core strengths and future potential is just beginning, so let's dive deeper and discover what sets this e-commerce leader apart. Shopify's recent results paint a picture of a company firing on all cylinders, demonstrating not just resilience but a remarkable ability to adapt and thrive in a rapidly changing digital economy. Over the past 2 years, Shopify has delivered a series of impressive financial performances that have caught the attention of both investors and industry analysts alike. Revenue surged by an impressive 26% in both 2023 and 2024, reflecting robust demand for Shopify's platform and services. This consistent double-digit growth is a testament to the company's strong value proposition and its ability to capture new market opportunities. Gross merchandise volume, a key indicator of merchant activity, climbed 20% in 2023 and accelerated to 24% in 2024. These numbers show that not only are more merchants joining Shopify, but existing ones are also expanding their businesses and selling more than ever before. Shopify Payments, the company's integrated payment solution, outpaced even these strong results, growing 29% in 2023 and an impressive 32% in 2024. This rapid adoption highlights how merchants are increasingly relying on Shopify's ecosystem for seamless transactions. Strategic initiatives have played a crucial role in this momentum. By targeting larger enterprise clients and expanding into new international markets, Shopify has broadened its reach and diversified its revenue streams, making the business more resilient to market fluctuations. Innovations like Shop Pay and the AI-powered Shopify Magic are empowering merchants to streamline operations, personalize customer experiences, and drive higher conversion rates. These tools not only boost merchant success but also increase the stickiness of the Shopify platform, encouraging long-term loyalty. After facing significant challenges in 2022, Shopify made bold decisions to cut costs, divest its logistics business, and refocus on its core strengths. These moves were instrumental in restoring profitability and setting the stage for renewed growth in 2023. Earnings per share soared by 50% in 2024, a direct result of disciplined management, operational efficiency, and a shift toward higher-margin services. This financial discipline has strengthened Shopify's balance sheet and increased investor confidence. Shopify's turnaround story is a powerful example of operational excellence and strategic clarity. The company has not only weathered past storms but has emerged stronger, with a clear path to sustainable long-term growth. With a renewed sense of purpose and a proven track record of innovation, Shopify is now positioned for even greater achievements in the years ahead, ready to seize new opportunities and continue its upward trajectory. Analysts expect Shopify's revenue to grow at a 22% CAGR through 2027, a rare feat at this scale. Earnings per share are projected to rise 8% annually, reflecting a maturing, efficient business model. Key catalysts: integrations with Amazon's Buy with Prime, YouTube Shopping, and even ventures into the metaverse via Roblox. Macroeconomic tailwinds, like easing rates and strong consumer spending, are boosting Shopify's merchant base. Record-breaking Black Friday and Cyber Monday sales in 2024 showcased the platform's scalability. Relentless product innovation, from advanced analytics to Shopify Magic, keeps Shopify ahead of the curve. This commitment ensures Shopify remains the go-to platform for ambitious brands worldwide. Shopify's push into the enterprise segment is unlocking massive new revenue streams. Shopify Plus delivers advanced features and customization for high-volume brands like Reebok and Warner Music. These big wins bring recurring revenue and powerful social proof, attracting more large clients. Enterprise clients mean higher average revenue per user and greater adoption of Shopify's services. While sales cycles are longer, these relationships are stickier and drive platform innovation. Serving both startups and global brands, Shopify proves its scalability and ambition. This upmarket shift adds stability and accelerates growth. Shopify's global expansion is unlocking new markets and multiplying its merchant base. Shop Pay, its one-click checkout, boosts conversion rates and reduces cart abandonment, strengthening the ecosystem. The Shop app connects merchants and shoppers, driving loyalty across the network. Shopify Magic, a suite of AI tools, automates tasks from product descriptions to customer support, leveling the playing field for all merchants. These innovations attract new users and deepen engagement with existing ones. As Shop Pay and Shopify Magic mature, they'll drive revenue and cement Shopify's leadership in global e-commerce. The company's competitive edge is only growing. No growth story is without risks. Shopify faces its share. Macroeconomic shifts like tariffs or trade policy changes can impact merchants and Shopify's revenue. Moving upmarket brings longer, more complex sales cycles and higher support demands. The e-commerce landscape is fiercely competitive, with rivals from platforms to payment processors. Regulatory changes in data privacy or digital commerce could require costly adaptation. Shopify's stock is volatile, with price swings tied to earnings and market sentiment. Acknowledging these challenges is key to a balanced investment view. Enthusiasm should be tempered with a realistic understanding of the risks. Shopify isn't cheap. At $105.03 per share and a $136 billion market cap, it commands a premium. But its track record and long-term potential justify the valuation for many investors. Since its 2015 IPO at $1.70, Shopify has delivered life-changing returns, peaking at $169 in 2021. Even after market corrections, early investors have seen 60x gains, far outpacing the S&P 500. This outperformance highlights Shopify's ability to innovate and capture e-commerce growth. The premium price reflects its status as a best-in-class operator in a high-growth industry. Shopify currently sits at a market cap of $136.05 billion. It has an earnings per share of $1.24 and a price-to-earnings ratio of 84.7, a clear sign that investors are paying a premium for what they believe is significant future growth. In 2024, Shopify reported $8.88 billion in revenue, with a healthy net income of $2.02 billion. Those numbers alone tell us this isn't just a company with a compelling story. It's one that's turning that story into solid results. What's catching attention right now is the resurgence in investor confidence. After a turbulent decade since its IPO, Shopify is back in the spotlight. A recent article titled, "The Ultimate Growth Stock to Buy with $1,000 Right Now," puts Shopify at the top of the list. And with good reason. The stock hit a record-closing high of $169.06 back in November 2021. While it's currently trading around $106, it's showing signs of renewed momentum. One of the biggest catalysts behind this renewed optimism came in May 2025, when Shopify reported earnings that beat expectations. The market responded quickly. The stock jumped 13% following the release. A key reason for the boost? A temporary easing of tariff hikes, which gave Shopify a bit of breathing room and helped improve its short-term margins. And it's not just the analysts taking notice. Investor interest in Shopify has surged recently, a clear signal that the broader market is once again recognizing its long-term potential. This increasing attention could translate into more buying pressure and continued upward movement in the stock price. So while Shopify's price may still be recovering from its all-time highs, the fundamentals and sentiment surrounding the company suggest that it's on a strong upward trajectory. For investors looking for exposure to e-commerce growth, software innovation, and a company with global reach, Shopify is certainly one to keep on your radar. For long-term investors, Shopify remains a compelling core holding if you believe in the future of global e-commerce. The key: weigh the premium against the potential for sustained high-octane growth. Spotting companies like Shopify is crucial for serious investors. Investing is about understanding businesses, trends, and your own risk tolerance, not just picking stocks. To help you grow, check out our Value Stocks Investing Master Course, your guide to finding undervalued gems and building a resilient portfolio. The course covers financial analysis, valuation, and risk management for all experience levels. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. Join our Patreon community, Stocks Galore, for deeper insights and a supportive network of investors. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Investing in your education pays dividends for life. What emerging trends or niche markets do you think will produce the next Shopify? Share your thoughts below. If you found this analysis helpful, comment and subscribe for more. Thanks for watching, and I'll see you in the next one.